Okay, hello Miss, my name is Zahad Ahmed, and in our presentation we're going to analyze IH Healthcare Berhad's financial health. So in this presentation we're going to start with an introduction and a company overview, then we're going to provide financial data collection, financial analysis, interpretation of financial analysis, and lastly we're going to analyze investments and give recommendations and end with a conclusion. IHH, or Integrated Healthcare Holdings Berhad, which is based in KL, Malaysia, is a significant private healthcare organization, which was formed in 2010 through the union of Pantai Holdings and Parkway Holdings. Pantai was a leading private healthcare provider in Malaysia, while Parkway, originally based in Singapore, had an extensive presence across Asia, including China and India. Since its inception, IHH Healthcare has undergone several transformative milestones. In 2012, the company acquired the majority shares of Acıbadem Sağlık, I don't know how to pronounce it, the largest private hospital group in Turkey. In 2015, IHH entered the Chinese market by acquiring a significant stake in Gleneagles Hospital in Hong Kong. In 2018, the company completed the acquisition of Fortis Healthcare, the largest private healthcare provider in India. Today, IHH Healthcare operates over 80 hospitals across 10 countries in Europe, the Middle East, and Asia, cementing its position as one of the largest private healthcare organizations in the world. So the reason why we chose IHH Healthcare is because it is a prominent player in the healthcare sector, thanks to its wide network of elite hospitals, which makes it an interesting topic for financial study. The company presents an intriguing candidate due to its ability to uphold robust sources of revenue and profits, as well as its flexibility and durability to sustain providing services and medical treatment, even in the midst of worldwide economic ambiguities and healthcare difficulties such as COVID-19. These factors also teach important lessons in managing crisis and tactical planning. Various streams of income are generated by the varied spectrum of services offered by IHH, which spans from basic healthcare to extremely specialized medical care. By lowering reliance on any one market or service line, this diversity improves financial stability as a whole. As financial analysts, knowing how IHH handles and maximizes various streams of revenue can be quite helpful. IHH Healthcare is listed on the main board of the Singapore Exchange and the main market of Bursa Malaysia Securities Berhad. The company's core business activities span a wide range of medical services, including diagnostic centers, hospitals, and specialized clinics operating under well-known brands such as Pantai, Gleneagles, Mount Elizabeth, and Fortis. IHH Healthcare is also actively involved in the growing healthcare tourism industry, attracting patients from around the world with its high-quality medical care and competitive pricing. To improve patient comfort and operational efficiency, IHH has made investments in digital health solutions such as EHR, telemedicine, and mobile health applications. The international healthcare sector is constantly evolving, driven by the COVID-19 pandemic and the need for personalized medicine and environmental sustainability. IHH, a major player in the sector, is exploring opportunities to improve services and expand its global presence through partnerships, acquisitions, and investments in medical technology. The company has integrated electronic health records, increased telemedicine, expanded its presence in Malaysia, China, and India, and is committed to sustainability and ESG activities. These strategic initiatives are expected to impact IHH Healthcare's financial performance positively. That's it for me. Thank you.
So for financial data collection, we've gathered all of our financial statements from the IHH Healthcare official website from a section called Annual Reports. The data includes financial position, annual income statement, and cash flow statement. For financial analysis, we have liquidity ratios. Our first ratio is current ratio, and a current ratio of more than one indicates a good liquidity. As we can see in the data, 2021 and 2022 shows a good current ratio, while 2023 shows a value of lesser than 1, which means that the company struggled with liquidity. Next, we have quick ratio, and overall, in 2021 and 2022, we see the same result as the current ratio, which is a value of more than 1, which indicates that the company has a good quick ratio, but in 2023, it does not have a good quick ratio. Next, for cash ratio, overall, we see that the company in all the 3 years struggled with its cash flow as the values are all lesser than 1. Next, we have activity ratio. Our first ratio is inventory turnover ratio, which measures how fast the company is using its inventory. And based on the above data, we can see that the company requires more improvement in utilizing its inventory. Next, we have day sales in inventory, which measures how the exact days that it takes for the company to utilize all of its inventory. And we can see that it takes a really, really long time, which is 104 days for all of the 3 years. Next, we have receivables turnover ratio, which indicates how well the company is able to manage credits or collecting receivables from clients. And based off of that, we can see that it's in a reasonable amount of time, but it still takes it should be shorter time. And we can see that in the day sales and receivables, which is 53.2 days. On average, it's 53 days. Next, we have payable turnover ratio, which indicates how well the company is able to pay its creditors and suppliers. And based off of that, we can see that the value is considered low, and it indicates a longer period than the average company. In days cost and payables, we can see that it's 118 days in 2021, 116 days in 2022, and 117 days in 2023, which is considered a really long time. We have total asset turnover ratio. Based on the data, we see that the values are considerably low, which means that the company isn't efficiently using its asset to generate its sales. For capital intensity turnover, it indicates that the company is utilizing its capital efficiently, and that's advantages for the company. The debt ratio, for the first debt ratio, it's the total debt ratio, and it measures the amount of debt a company has compared to its asset. So the lower the TDR, the less likely the company is facing financial risk and it's not relying on debt financing. So overall, we can see that the company is doing well in terms of its debt. Next, we have the debt equity ratio, which measures how much the company finances its asset to cover its debt and shareholder equity. So based off of the data given, we can see that the company has a relatively low level of debt compared to its equity. Next, we have the debt asset ratio, which shows how much debt the company has compared to its asset. And based on the data, we can see that the company has good liquidity, and as the current ratio also shows that. Next, we have debt capital ratio, which shows how much debt the company has compared to its capital. So in comparison to all the 3 years, we can see that there's a slight increase in 2022, but it's still maintained to have a low debt overall, which is a good thing. Next, we have the debt EBITDA ratio, and this ratio shows how much debt the company has compared to its earning before interest, taxes, depreciation, and amortization. In general, it has a low value, which is considered to be good. The equity multiplier, which in general, we know that lowering the equity multiplier reduces the risk of increasing company debt. Overall, the equity multiplier decreased over the 3 years, and that means that the company reduced its reliance on debt financing. Okay, next we have profitability ratios. Firstly, we have profit margin, which shows how much revenue the company can hold on to as profit. Overall, 2022 recorded the lowest value, which means that there was less revenue, and 2023 recorded the highest value, which is the most revenue, which means that it's a remarkable financial performance of that year. Next, we have return on assets. So RA is the company's method in identifying how well it's using its asset in order to generate earnings. Overall, these values indicate the company is facing issues of profitability and is not efficiently utilizing its asset to generate its earnings. One of the most important ratios to identify how profitable the company is and how efficiently it generates its profit. The highest value was 10.68, which shows that the company was more profitable at that time, and the lowest value was 6.37, which means that the company generated lower revenue. The market ratios, which is price earning ratios, and this ratio is to determine whether the company is overvalued or undervalued. So the higher the value, the more overvalued the company is. So we can see that in 2021 it recorded the highest value at 37.1, which was extremely expensive, and 2023 was the lowest, which is a reasonable price. Next we have the price sales ratio, which, as we know, the lower the value for the price sales ratio, the better, because it's more appealing to investors. And as we can see from the 3 years, 2023 recorded the lowest value, which means that it became more reasonably priced. Next, we have market to book ratio, and as we know, if the value is higher than 3, it suggests that the company is expensive for investing, and if the value is under 1, it suggests that the company is undervalued. So overall, we can see that in 2021, the value was 2.88, which means that the company was considered quite expensive, but the value was more reasonable in 2023. Next, we have the EBITDA ratio, which is a ratio that's important to tell us how much the company is earning before interest, tax, depreciation, and amortization. And we know that high EBITDA ratio is generally a positive thing for the company, as it means its earnings are higher compared to its operating expenses. So EBITDA ratio, which is important to tell us how much the company is earning before interest, tax, depreciation, and amortization. Generally, a high EBITDA ratio is a positive thing for the company, as it means earnings are high compared to its operating expenses. So in 2021, it recorded the highest value, which is a good indicator that the company is profitable and efficiently reducing its operational costs. But in 2023, we see that it's a concerning value because the profitability has decreased. Thank you.
Hello, I'm Dana, and my part for this summit is Interpretation of IHH Healthcare Financial Analysis, and we're going to start first with comparison to industry benchmarks. So first, in 2021, the company showed a current ratio of 1.41, which shows favorable liquidity position. And then for 2022, the current ratio fell to 1.14, which indicates reduced liquidity, although it still could maintain a position where the current assets could cover the short-term liabilities. But then, unfortunately, in 2023, the current ratio fell further to 0.90, which indicates potential liquidity issues, as the company may struggle to meet its short-term obligations, and it can be quite problematic because the industry benchmark could always be around 1 or even higher. And then for the second part is key findings and insights. For key findings, at first we very clearly can see the liquidity decline. The company's current ratio always showed a decreasing trend from 2021 to 2023. And then there's the potential liquidity problems in 2023, as it started from 2021 in 1.41 and it reached 0.9 in 2023. The company will struggle to pay its short-term debt. And then there's hitting the benchmarks. The company IHH Healthcare may not perform as well as the industry average because it continuously shows a declined liquidity rate. And then in insights, the first one is risk of short-term solvency, because the declining current ratio suggests increasing short-term solvency risk for IHH healthcare. And the second one is the need for strategic financial management. The company must adopt a strategical financial management to improve liquidity and stabilize financial situation, their own financial situation. And then, last but not least, there is the strength and weaknesses. For the strength, the initial strong liquidity in 2021, IHH Healthcare showed strong liquidity. 1.41 is a really good place to start for their company. And their large-scale operation. With extensive operation in the healthcare industry, IHH Healthcare has significant assets that can be better utilized for liquidity management. While for their weaknesses, as was very clear, a declining current ratio, so a continuous decline in the current ratio over the past 3 years. And for solvency challenges in 2023, a current ratio less than 1 in 2023 indicates serious liquidity problems that require immediate strategic action to improve cash flow and reduce liabilities. Thank you.
First of all, Assalamu alaikum wa rahmatullahi wa barakatuh. Hi everyone, I'm Osama Ibrahim Umar. I'm gonna present investment analysis and recommendation for IHH Healthcare for 2021 until 2023. First, revenue. Revenue increasing from 17.34 billion in 2021 to 19.60 billion in 2023. Net profit improved from 1.86 billion in 2021 to 2.10 billion in 2023. EBITDA rose from 3.25 billion in 2021 to 3.65 billion in 2023. Total assets grows from 74.30 billion in 2021 to 78.50 billion in 2023. Total equity increased from 31.50 billion in 2021 to 33.00 billion in 2023. Dividend yield increased from 1.2% in 2021 to 1.4% in 2023. First, 2021. In 2021, financial performance, strong revenue recovery, driven by higher patient volumes and elective surgeries, and sufficient improvement in net profit due to better operational efficiencies, and APS recovery to 0.20 RM, and the strategic moves expansion with new faculties in India and Turkey, and focus on digital health solution, including telemedicine and AI. And in 2021, the recommendation by strong revenue recovery, strategic expansion, and digital initiative indicated growth potentially. And second, 2022. In 2022, financial performance continuous revenue grows throughout a slower pace and slight decline in net profit due to increased operational cost and special cash dividend announced from 2023. And strategic moves divested stock in IMU Health Southern Bhatt to focus on care operations, emphasize on sustainability, including green hospital and carbon reduction. And the recommendation for 2022 hold due to steady growth, but continuous approach due to slight dip in net profit. And last one, 2023. In 2023, financial performance, positive signs of revenue growth in the first quarter, and improvement in profitability expected as cost management strategies takes effect, and IPC project to return in 2021 levels, and the strategic moves continuous innovation in AI and telemedicine, and global expansion with new hospital opening and capacity expansion. And the recommendation for 2023 by positive outlook with better financial performance and strategic growth innovatives Focus on innovation and high growth market offers long-term value. And last but not least, conclusion. IHH Healthcare has demonstrated really resilient and strategies foresight through pandemic, achieving steady revenue growth and focusing on sustainability and innovation. Investors are advised to consider buying or holding the stock based on their investment horizon and risk appetite.